Good afternoon, ladies and gentlemen. I'd like to welcome you to this webinar hosted by Pula Capital. My name is Brian Rainier. I'm a director with Pula and I will be your host for today. I'm going to take us through a relatively brief presentation and will be followed by your questions. So if you could write your questions down, you'll be able to do that through the webinar software, and we'll take those at the end of the presentation. So by way of quick introduction, Pula Capital is the investment arm of LRMG, and LRMG is a 22-year-old company. We're 55% Black owned, some 300 employees, and we're a business consultancy that helps companies perform at their peak. We've shown some consistent growth of around about 20% per annum over that time period, and our big aspiration is to list our business in 2025. LRMG did a BEE vendor financed deal alongside an employee trust many years ago, and it essentially applied the very same principles and structures that we are going to be covering in our presentation here today. So just to take you through the agenda, what I'm going to look at is really what has changed for qualifying small enterprises and what are the implications. And what we're concentrating on in this webinar is really the ownership aspects of that. We're going to touch on trusts and why they're under fire and the implications there for ownership. And then we're going to look a little bit more specifically at, what have been the issues around actually doing deals in this space, and what have been the problems with getting funded deals. How do they work? How do I value my business for a BE transaction? What are the kind of things I should be really looking for in terms of a BE partner? And then to finish off with, I'll just share a little bit of our experience gained over the last 2 or 3 years with the investments that we've made as Pula, and then get to answer some of your questions. So moving on directly then to the major changes in terms of ownership. And we're looking at what has really happened in terms of small enterprises, which is those with a annual revenue of less than 10 million, and then qualifying small enterprises, which those with a revenue of less than 50 million. The biggest change that has happened is that the modified flow-through principle, and the modified flow-through principle is really where there's deemed 100% ownership at a level where the actual ownership is less than 100% but greater than 50%. So typically where you're a Black-owned business that's, say, more than 50% owned, the modified flow principle in certain instances can be used to say that 51%, for example, is actually 100%. And that's to make the distinction between a company or an individual. Obviously, a Black individual is 100% Black in terms of recognition. So in terms of the automatic ownership calculation, there was some ambiguity around the codes as to whether the modified flow-through principle could be used or not. And the Commission and what is now being published in the Government Gazette, and which will become effective from the 1st of December 2019, is that you can no longer use the modified flow-through principle for automatic ownership. So to get automatic qualification as a level 2, as a black-owned business, you require to have 51% direct black ownership. Otherwise, you need to go through a qualification or a verification process to get your score. Similarly, to get level 1, you would require to be 100% black owned. It's still possible as a small enterprise. Sorry, that's a bit of a typo. That's supposed to be an ESC. You can still get level 4 automatically, and that is, as for all of the above, just through the filling in of an affidavit that you are either 51% directly black owned or 100% direct, or you are an EME. You can get a higher scorecard than level 4 if you're an EME, but you would need to go through the full verification to get that if you're not directly black owned. I think what's most important here, and this goes to the businesses that are purchasing from you, you can still use the modified flow-through principle to get maximum procurement points, and you will be qualified as a black-owned QSE business using the modified flow-through principle. So a large business that wishes to procure from a black-owned business, and in this instance, the number of points that's been allocated has been increased from 9 to 11 points in the procurement side of their scorecard. You can use a business which has used the modified flow-through principle, and the target of that spend for large organizations has moved up to 50%. Furthermore, using the modified flow-through principle gives maximum ownership points. If the ownership is at 51%, for example, and that can be used to translate to achieving a 25% target. Okay, moving on to trusts and why they're under fire. So originally, 15 to 20 years ago, the emphasis on black empowerment was far more around broad-based, and a number of schemes and trusts were set up to be far more broad-based than they are today. So this has been a bit of a moving target, and there is now a very clear directive from government to eliminate the broad-based schemes that really benefited the black public, but didn't give much concern to the actual rights of ownership or even real defined economic benefit. So a number of these existing structures are being challenged. They are being opposed, but as we see in the news just last week, MTN has conceded that it will need to go back to the drawing board in terms of how it structured its massive trust. And that's obviously very big, and we can see the kind of pressure that's being put on organizations to move more to an ownership-based trust. So the key requirements that are being provided by the Codes of Good Practice, and these were put out by the BBBEE Commission in around about November 2018, is that there have to be identified participants in the trust who hold the shares, and these must have the right to vote, to receive economic interest, for example, in dividends, and at some point in time to receive an unencumbered ownership of the shares that have been used to calculate the black ownership of the trust. And then furthermore, the Commission is clamping down on those instances where a trust has been put in place, and the beneficiaries are just changed from year to year depending on who moves through, for example, the employee pool. And what is now being mooted is that the trustees won't have discretion to change the participants or their rights. So once the trust is set up in terms of getting recognition, it seems to be what they're saying is it's pretty much cast in stone. Moving on then to having a look at some of the deals and typically the challenges that these face. What we've seen, and this has been over the last 20 years, and I would think the failure rate of BE deals must be greater than 80%, is that simply the cost of funding is too high relative to the ability of the dividends typically to cover the repayment of that debt and the capital. Or secondly, and this is linked, the valuation expectations are just too high for the funding structure to work. And the reason that we face these challenges is that the rules stipulating how ownership is actually earned is that the codes stipulate that a minimum of 10% of that ownership must be paid off, i.e. unencumbered, every year. In order to get the maximum points, one needs to have a target level of around about 25% of ownership. Or if you're a QSE and you wish to demonstrate the maximum procurement points, and we're seeing that there's a lot of pressure from large organizations to say, we want to buy from QSEs and we want to buy from black-owned QSEs, i.e. the 51% becomes very important. And then thirdly, one of the most difficult things as well is that if money is coming in to fund the deal, typically if it's third-party money, i.e. the black entrepreneur or the business has gone to other agencies like the banks, the financial institutions, the IDC, NEF, etc., they're looking for a minimum equity funding return of a minimum of around about 15%. And what I'm going to show in the next table is really how difficult it is for a business to achieve funding that level of finance on their deals. So in the next slide, if we have a look here at a BE deal that gets done, and we say, okay, it needs to earn in at the rate of 10% per annum, and it's a 10-year deal, which is allowed by the codes. So as long as 10% per year is being paid off, you can get full recognition, depending on the percentage that's being bought. And we assume in this case that this business shows a profit margin of around about 10%, and that the deal gets paid for out of the dividends that the business provides. So if we have a look at the table, in the first row, in the first column I've got there, and what I'm trying to show here is what level of growth do you need to display as a business, and how much do you have to pay out in terms of dividends, and doing that, what is the maximum interest rate that would be achievable in order for that deal to work, i.e. for the interest to be paid off and for the capital to be paid off at the rate of 10% over 10 years. So in that first example, you would need to grow, if you were growing at 20% and you had a 25% dividend payout, then the maximum interest rates that the structure would be able to work with would be a maximum interest rate of 5%. If, for example, third-party money was used and 15% was the rate at which that money was borrowed at, you would need to be paying out 50% of profits in dividends, and you'd need to be growing at 20%. If we were more conservative with our growth rate, our revenue growth rate, and we said that was probably, well, more likely around about 10%, given the tough economic conditions, certainly in the midterm, that's probably more realistic to shoot for. What would the dividend payouts need to be there? So at 25%, or a quarter of your profit, paid out in dividends, and remember, the dividends go both they go to both shareholders, both the original shareholder and to the BE shareholder, depending on their stake. That would be a zero interest rate deal, but at 15%, you would need a 70% dividend payout. And then in the bottom row, what I've showed is, if we were to say we did a funded deal at 15%, what would be the actual revenue growth that we required in order to grow? So if we had 25% dividend payout at 15% interest to do the deal, we would need to be growing at the rate of 32% per annum. Similarly, if we had 50% of our dividends paid out, it would be, and that's close to that 20% we covered further up, around about 18%. And then if we paid all the profit out in terms of dividends, we would need to just maintain our current revenues over a period of 10 years. So what are the risks of not being able to pay off the funding, or for the unencumbered ownership to be realized every year? First is that if you don't make that payment, you don't get the credit on your BE score, and your BE rating consequently suffers. Secondly, if you miss out a payment, the interest then starts to compound on those missed dividends, and sometimes deals never catch up. And what I've seen in my experience is that, the empowerment partners very often, who've been very optimistic in going into these deals, getting financing, backing themselves, going in, having expectations of very strong growth, suddenly within a year or two, they see this isn't happening, and now they're on the hook for the liability that's sitting out there. So they quite often decide, no, this is not going to work, and therefore look to exit the deal, leaving you in the position of either the funder taking over the shares, because quite often they've taken them as collateral, or secondly, you just have to write it off in some way. In some cases, it gets quite nasty, and that there's an argument over, well, what is the value over the last 2 years that I've had? Yeah, it's not a pretty scenario, is what I'm saying. So how do you mitigate against that? And our proposal is that you keep the funding in-house as far as possible, and this is what is known as vendor financing. And this is typically where you, as the QSE shareholders, put the deal in place, and you provide the funding to your BE partner, and they pay you back basically over a period of time. And the second point about that is to keep the rate as low as possible, taking cognizance of the table that I've shown up here on the left-hand side. So you can look at the kind of growth rates that you really think is achievable. What are the dividend payouts in terms of what you can afford in terms of needing to still fund the business going forward? And then you can say, well, this is a reasonable interest rate, anywhere from 0 to a maximum of say 15% in terms of the scenarios that I've shown above. So I know that's quite a technical subject, and any of you are welcome to contact me if you really want to go into it in a bit more detail to understand that. But I'm going to move on a little bit now to how do I value my business for a BE transaction. And essentially, this is just the flip side of the same conversation that we've had. And I hinted to that in the beginning, saying that most deals failed because the funding rate was too high, or the valuation was too high, i.e. it couldn't be funded. But essentially, again, the valuation typically gets fixed by what it is that you're trying to achieve and the rules. So you kind of work backwards, and it depends on the following assumptions as to who's providing the funding and the applicable interest rate, because as we've seen, those are kind of fixed in terms of whether they work or not. And you need to see what growth you think the business can deliver, what your dividend payout ratio is, and what is the time horizon. And then essentially the value of the business is fixed by the ability of the business to pay out of dividends. And the calculation is relatively simple in that it's the annual dividend payment that gets made, multiplied by the time horizon. So if it's 10 years, it'll be the annual dividend that's paid out multiplied by 10 years, and then divided by the dividend payout, anywhere from, say, 25 to 100%. So again, just to give some context and an example, let's assume we've got a business which is doing a 20 million revenue and it's on a profit margin of 10%. Let's assume it's vendor financed at a nominal interest rate, and it's achieving an annual growth rate of 10%, and we've assumed a dividend payout of 25%, and it's going to take 10 years to pay off. And you see those are criteria that say, okay, this is the kind of deal that can work. Given those parameters, this deal will be able to pay for itself. Then it's simply the revenue times the margin by the dividend percentage by 10 years, and then divided by the actual dividend payout ratio. And what that says is it's 20 million will be the value of the business. Once again, if you'd like me to take you through these in a little bit more detail for your particular business, give us a call. So moving on, and when we look at investing in companies and doing a deal with them, there's very much a reciprocal the criteria that we look for, and that I would suggest that you look for in terms of a BE partner. And the first one that we found is that you've got to really look for someone that you can trust and that you enjoy working with. Equity transactions are difficult. Running businesses, we know, is hard. It's not all plain sailing. And you really need to find a partner that you can have very open discussions with around growth, around dividends, around what's required for the business, around value that's being added to the business. And that's the second most important thing that we see, is that you really need to be working with someone that can add value to your business. And that's to you as the person selling, as well as it's us as the investee company, because typically we're as the investor, because we're typically looking for businesses that have got the real potential to grow, and in that way also add value to our broader business. And importantly, rather than just cash and or a promised network, we would say go and have a look at the business that you want to get into partnership with, and have a look at their actual operational networks. Are they actually going to be able to take you into a client base that they've built up, that's well established, that can help you leverage your business into a bigger environment? And then look for the synergistic benefits in terms of cross-selling. Look for, is there synergy in terms of sharing infrastructure, marketing, even to the extent of sharing space and rental. I think you need to look for someone that can really help you in terms of improving all aspects of your BE scorecard. So it's not just about ownership, it's also around your employee base, and helping you find Black executives to come into your business and to help your business grow. as well as to help you, giving you advice in terms of procurement and the other elements of the scorecard that are required. But the bottom line is you really need to look for someone that you feel that can actively help you grow your business and help you achieve the kind of growth in order for you to be for them to be able to pay for their stake over a period of time. So I'm just very briefly going to share a little bit of our experience. So we've been going for about 2 years, really operationally, and in that time we've done 4 deals. We aim to do between 2 to 4 deals per year because we're spending a lot of time working with our investees in terms of helping them get up and grow. And we see ourselves very much as a business accelerator in many respects, given that as LRMG, if you remember from our introduction, is a business which helps businesses achieve their best in terms of performance. So typically we're looking at QSEs, which have got a revenue of between 10 and 35 million per annum. The margins of the businesses we've invested in are between 10 and 20%. And there's very definite aspirational growth there of the order of 20% or more. So typically, given our 2025 listing aspirations and the fact that our investees are invited to be part of that, our timeline is designed to achieve 51% ownership by then. And typically, the kind of deals we've done have been vendor financed at low interest rates. Given that we've got an accelerated time period of not the 10 years, but we'd like to do it within closer to 5 years, there's typically a 10% dividend payout that we're looking at, but with flexibility around working capital, which we're also prepared to get involved with from a co-funding point of view if that's required, and so as not to put the structure again under pressure. Typically, the valuation works out at a price-earnings ratio of around about 5 times, i.e. we're paying for about 5 years worth of earnings, and if you assume that 100% dividend payout, then you can see that we're looking for a full 5 years of earnings and to pay off out of dividends over 5 years. What we found is that there's a varying degree of desire to integrate within our bigger organization, and we've seen businesses wanting to become fully integrated with us, and we've seen those that want full operational independence, yet they still want to, and we certainly help them, leverage our customer base and our management expertise. And we've got companies that have come in and are actually renting space. They're using our shared services in terms of finance, HR, payroll, etc. And then we've got others which are on a satellite model, and they come into our joint sales meetings, and we help them and we take them into our larger client base. So just to share with much authenticity some of the challenges. We know that it's difficult. Equity deals are difficult, as I said earlier on. The challenge is always about understanding each other's businesses and the people and the dynamics and the different cultures. And we take time. We certainly take time to understand that. And coming back to my first point around who do we want to do business with, we certainly want to do business with people that we like and who like us and who want to do a deal. And then it's into the nitty-gritties of really getting to understand the businesses and the constraints and opportunities within those. Unlocking synergies does take time. And as an organization, we spend a lot of time understanding collaboration. So within LRMG itself, we have 10 different business units, each of which focused on different product sets and markets. And there again, we are taking the business of collaboration into its broader context. So it's not just with the Pula partners, but it's each business unit has to really find a way of how do we best cross-sell and get the best synergies through collaboration. So our third challenge is, I think, we're seeing that times are tough. So we've done deals, and the businesses we've been involved with have not performed as according to expectation, and that has very little to do with BEE or even our involvement. It has to do with the fact that they've lost major contracts because they've been exposed in terms of perhaps a high concentration of customers. And again, we've been able through a flexible structure that we've put in place to be able to stay alongside them and to still give them the ownership and the support that they need. And we take a long-term view. Our view is a 5 to 10 year view. We're not a typical private equity business looking to come in, take a stake and flip it out. We're looking at providing you the support and for you to become part of a bigger organization and leverage off what we've got for you, whilst still retaining the independence and the entrepreneurial mindset. I think, the highlights have been that we've seen that there's been significant cross-selling, and we've seen that both to LRMG and externally across over to external clients. So we've been able to take our investees into our client base. They've been able to take us into their client base, and there've been cross-selling opportunities between us. We've also, given that we've looked to businesses where we can really leverage and what we do, we've actually sold services into one another as well. So we're actually helping by, as we say, drinking our own champagne, using the products and services that we've both got to offer. Something that's worked very well is that we've invited the investees execs to join us in our group exco. Our excos are very special. They're typically a one-day affair, and they are largely focused around strategy and sharing the business experience of the various business units. So we, as I said, we within LRMG, we're 10 business units, and with the investees, that's up to closer to 14 business units, all in different stages of the life cycle. And there are lessons to be learned about all of those, from the mature businesses and what they're seeing out in the market to the startups that are cash hungry and have working capital challenges. And as I say, we've got 22 years of experience and have built the business in that time up to 300 people. So we can certainly bring our experience over those years to helping each of the business units. And we're excited together. Our mantra is #BetterTogether, and we're looking forward to achieving that 2025 listing. So I'd like to, that's the formal part of our presentation over now, and I'd like to open up the floor to any questions, and you can enter those into the webinar.